And yes, it looks like a 13-year high for the NASDAQ. Let's get to today's action. Peter Kenny, KCG Managing Director, is telling investors to brace for more volatility. And Larry Shover is in the pits of the CME. Look, I could start with Larry, but both of you guys can weigh on this. What volatility? The only volatility, Peter, is to the upside lately.
Well, over the last 4 or 5 sessions, that's certainly been the case. But if you look back from the beginning of the second quarter through to today's close, the swings, intraday swings in the market, though recently they've been very much to the plus side, they have been two-sided. The second quarter was very much a horizontal move from the beginning to the end. We're seeing a bit of a lift here being driven largely by earnings that are coming out, positive employment numbers, strength in housing and autos. So we are seeing that leg up that you had mentioned before I came on, and that leg up is very susceptible. I mean, there's lots of headline risk out there. It's not all rosy.
Well, you mentioned headline risk. You know, it's funny, Larry, the Fed minutes out tomorrow. The last 3 times the Fed minutes has come out, the market has sold off. What are you expecting tomorrow?
Well, I think more intraday volatility, just like the other guest said. I mean, right now, the pain trade does seem to be to the upside. However, a lot of people are on the sidelines just because of what you said. The last few times that happened, the market did correct itself. And we do know we're bumping up to a really big resistance at 1650 in the S&P 500. And most traders feel to get meaningfully higher than that, we need to see some compelling evidence out of the earnings reports that are going to start flowing July 15th.
Well, here we are above at 1652, and you look at that, Peter, and I'm just wondering now, what you said is very true, that good news is finally being taken as good news until it isn't, until people realize, oh, the better this economy gets, the sooner we might see tapering, which shouldn't be so gevaarlijk. I mean, it shouldn't be the worst thing in the world, certainly.
No, actually, from a purely academic standpoint, it's actually very good news to hear such free-flowing discussion about tapering, because it's a clear indication that the economy has caught that sustainable traction that we all ultimately want. I mean, any of us really want to have to depend on liquidity that is being infused by the Federal Reserve for the market to find buoyancy. We want organic growth. We want top line and bottom line. We want revenue growth. We want real growth in the economy. And as long as we see more of that, the greater the likelihood is, the sooner we see tapering. And that's not all bad.
Well, let me follow up on that, Peter. With rising rates, as we've seen with the talk from the Fed easing its monetary policy, how does that affect your investment strategy?
Well, basically, we're still, by any historical standard, at very, very, very inexpensive rates. Even though just recently, since roughly in the last 2 weeks or so, we've seen a fairly sharp move in the 10-year, for example. We have, over the last 2 sessions, seen some moderation in the 10-year. So it's not a one-directional trade, though we probably have seen the lows for the time being. That said, even a minor adjustment in rates moving higher shouldn't provide the headwind that many people are anticipating it will for equity markets. Equity markets can move up even in an environment where interest rates are climbing higher as well. We've seen this repeatedly. Going back to 1982, there have been several cycles of low rates moving higher and the equity market continuing to move higher. That having been said, if you're going to continue to see interest rates rise, that's probably not going to be terrible for the rate of inflation as it currently stands, and it's probably going to be very therapeutic for the earnings season.
Well, exactly. But Peter, Larry, we are seeing inflation, certainly. Say, for example, in China, we got out of Shanghai, we got these numbers that looked hotter than expected for inflation. And just in the last hour, Jim Awad of Zephyr was saying avoid Brazil, because Brazil used to export to China. And now China's not such a great market as everybody's looking at some of these numbers. So how does that then, how does that piece of the puzzle fit into the U.S. economy?
Well, that's a big question, because we all worry about China, and you're right, CPI came out hotter than expected. It was offset with a PPI being a little bit softer than expected. But again, we're more worried about Brazil, Mexico, Korea, et cetera, the emerging markets. And so our dollar going higher, that's going to really hurt. And that might be the missing puzzle right now that's going to unhinge this market. I mean, I am constructively bullish for the equity market. However, the emerging market's a much bigger thing than most of us are giving credit for right now.
All right, Peter, time to show us the money. Where do you like, what sectors do you like in particular? Are there any particular stocks out there that you like?
Well, I can't be stock specific, but I've been harping on these sectors for quite some time, as you well know. Housing, financials, autos. All three of them have been real stalwarts, real bulls in this move. They've outperformed the broader indexes. They're likely to continue in spite of the fact that we're going to continue to see this shift higher in rates. All of them speak to a strengthening domestic economy, an economy that is really the flagship of the global GDP story. The U.S. consumer continues to grow in confidence and in demand. That is driving these three sectors and should continue to do so.
Well, all the charts of these spiders look almost exactly the same, almost a moonshot, with just a little bit of a jagged edge here. But again, the big question now becomes where is there cheaper opportunity, and is it emerging markets? Do we or don't we? Everybody has an opinion on this.
No, emerging markets clearly represent a very risk-on profile for investors at this stage of the game. And part of that is because of the concern over global demand, global natural resource demand, cheap manufacturing demand. And you mentioned Brazil, that's a classic case in point. And the other guest mentioned several other emerging market economies that are really heavily dependent on the global demand scenario. And it is, quite frankly, not robust around the world. As a direct result, the U.S. economy, which is maintaining some sort of competitive advantage as a direct result of the weaker dollar, vis-a-vis quantitative easing. There's a window on that, and I completely agree with the other guest in that the stronger the dollar gets, the less competitive advantage we have in terms of manufacturing and exporting. So we need to kind of capitalize on that.
Good to see you both. Peter, Kenny, and Larry, we'll check back in with you in just a few moments to see how the S&P futures close. But again, looks like a win, a 13-year win for the NASDAQ. It closed at 1304, needed to best about 1302.
Impressive. It just hung in there, didn't it, while it settled. Internet stocks like Google. All right, S&P futures closing now, or very shortly will do. Let's head back to Larry Shover in the pits of the CME. Larry, what are they telling us?
What they're telling us is that we're not complacent, we're not oblivious to the market risk, to the problems of the world. What they're saying is that the market's doing a fantastic, a splendid job at just compartmentalizing every issue and not making every issue out to be some type of disaster, some type of, Lehman-like macro catastrophe that just takes 100 points off the Dow and the S&P 500. That said, we are concerned with tomorrow. We're concerned with earnings season. But other than that, the market, it does feel painfully higher. People are on the sidelines, but cautiously optimistic.
Okay, we'll take that.
We will indeed. We love it. Thank you, Larry.
Thank you.